Hello there. Welcome. My name is Marche. I'm the webinar director here at Advice Chaser. And before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during or after the webinar today as appropriate. And please note, we do have a question and answer period at the end of the presentation. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your phone number as well. We will make sure someone reaches out to you after today's event. We want this to be as educational as possible. So once again, please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's guests. Our moderator today is Libby Van Vliet with 10 Bridge Partners, and she handles everything from opening new accounts to changing contact information, making distributions, and handling incoming contributions. She believes in teamwork, professionalism, and lifelong learning. She loves to serve clients as they launch on a path to reach their goals with a sound financial plan. She is a native of Portland and enjoys outdoor activities with her family and her dog. Libby, come off of mute so they can see you and say hi.
Hi there. Thanks for having us today, Marche.
Very good. Thank you. I'd love to introduce you to today's presenter. Eric Lawrence is the president and managing partner of 10 Bridge Partners in Portland, Oregon. As a certified financial planning practitioner, Eric knows that financial planning is as much about emotions as it is about finances. He advises clients to understand their own individual relationship to money, what excites them, as well as what keeps them up at night. Then the financial plan and resultant strategy have a much better chance of success. Eric and his team work closely with clients to make sure they honor this relationship and put them on a clear path, guided by a sound financial plan tailored to their unique goals. Outside of financial planning, Eric enjoys the outdoors and spending time with his family. We have had Erica and Libby on a couple webinars, so we will make sure that those of you who are attending here today get a link to that in the follow-up to this webinar. And we'd like to turn over the time to you, Eric.
Wonderful. Thank you so much, Marche. Yeah, I can't believe we're back for our third webinar with Advice Chaser. It was a lot of fun the first two times, and our thanks to you, Marche, for making them fun, because you are the pivotal person in bringing us back. So we're very pleased to be here, and you know, insurance basics, pretty much the title can put anyone to sleep, but I want to talk about a higher level kind of insurance discussion, because I think that a lot of people, when they buy insurance, really look at it as just a product they pull off the shelf. They buy it because someone says so, and then they put it in their files and they don't worry about it anymore. And so we want to get a little more in depth on what insurance is, why you would own it, what you would buy, and then just kind of the process of going through that, and then how you evaluate that on an ongoing basis. So if it's okay, then I'll just get started. Insurance is a tool, and I think everyone needs to realize that insurance is simply that. It's a tool, and there's as many different tools out there as there could be in a toolbox. But you wouldn't just arbitrarily go to the store to buy a hammer if you didn't need one, or you didn't have a project that you needed to do. And insurance is much the same. A lot of times insurance gets presented to us by our agents or by insurance salespeople and we almost get talked into a particular policy. And I'm not saying they're wrong, only that they present a problem for us that maybe we didn't know we had. They present a solution that maybe we didn't know we needed. And they give us all the good reasons on why we should own it. And we do it at their advice, which is great. But it should serve a purpose. So all insurance policies are designed to absorb risk. I should preface that by saying, I always say insurance companies are a necessary evil, just like big banks, right? I'm not a fan of either one, but they certainly serve a purpose. But insurance is about absorbing risk, the insurance company taking risk away from you so that you don't need to bear that risk. So the very first thing people need to do is identify a purpose for their insurance. If you live in Cincinnati, Ohio, you certainly would not go out and buy earthquake insurance because it's probably not something you need to worry about. Or if you live in Portland, Oregon, you probably wouldn't go out and buy tornado insurance because it's not something we need to worry about. So I really encourage people to remember that there are two very distinct ways of thinking about insurance and risk. One of those is the possibility of an event happening. Yes, it is possible that Cincinnati, Ohio could have a big earthquake or that Portland could have a tornado. But what you really need to ask yourself is, what is the probability of that happening? That's a much more important part of the equation. Statistically speaking, most people between the ages of 25 and 65 have a very low probability of dying, but a much higher probability of being disabled. So when you're thinking about insurance policies you should own, think about the probability of that event, not the possibility. Everything's possible in this world. Anything can happen. But what we like to talk about is, what is the probability of that event happening when we're going to allocate our money towards insurance. I also encourage people to work with a broker rather than an agent. That's not to minimize the value of an insurance agent, but if you go to your State Farm insurance agent to buy a product, they're going to present to you State Farm products. If you go to a broker that represents multiple insurance companies, they're able to go around and shop products for you and help you find the best one for your thing. But I always want to tell people to remember, insurance is a process, it's not a product, and it takes time. So on this first step, identifying the need for insurance, why would we have that need? Dying is certainly a risk to the family structure or to the household. It's something that we all worry about, and it keeps us up at night. So insurance are sleep good at night products, not investments. They do like to present them sometimes in the commercial, in the ads, like they're there to make our lives better, and that by buying their products, we're going to be much happier people. But, when you buy your life insurance, you're buying it so that you can sleep good at night, knowing that your household is going to be okay if suddenly you're not there and your income's not available to help the household. So when you're talking about, why I'm going to have this, you have to have a reason. So I bought my first life insurance policy at the birth of my first child. There was a reason that I had that in place. My wife was a stay-at-home mother. My earnings were the primary source of income for the household, and I had a child at home that I needed to be able to protect. Most likely, now I'm 51 years old. It's 30 years later, and I still haven't died, thank God, knock on wood. There, you can hear that. But for me, I bought a lot of insurance back then. And so it was really looking at what helps me sleep good at night, even though I had a very low probability of that happening. There's kind of two ways to think about life insurance. And I'm just going to pick on this a little bit because I think in the end, you have to look at other insurance policies the same way. How do I evaluate the need for insurance? But you have to look at all the different things in your life. Okay, first off, what are high probability events that I need to insure? But you also need to recognize whether or not you can absorb that risk. So when I look at life insurance, it was either the life value approach, we call it, where I simply say, I want to replace my earnings for my wife for the rest of her life. That kind of rhymed a little bit there. I didn't mean that, but I want to buy, enough to cover it. You can imagine this is a big number. Think of it this way. If my wife was to take the death benefit proceeds to an advisor and say, invest this for me and give me the equivalent of my husband's income for the rest of my life, what rate of return would we need to get that to get there. So this is the life approach, replace the earnings for life. The other approach is a needs-based approach where I just add up everything that I want to get paid if something happens to me and then total those at the bottom and you get a number. So the insurance is the probability of needing it and then looking at what is the potential for loss and then how do I want to insure against that loss. And that's measuring the impact and your ability to absorb it. So through the financial planning process with our clients, we will stress test their financial plan based upon death, disability, care, all kinds of different variables, loss of income. We're going to gauge whether or not they can absorb that impact. And for some clients, the answer is yes, they can. If you can absorb the impact of someone dying and maintain the household and there's no fluctuation in the quality of life from a financial perspective, then maybe life insurance is something that I don't need. If I have enough money in the bank that, I can afford to, cover the cost of an earthquake and the damage to my home, maybe buying earthquake insurance is not something that I need. But you first need to gauge the need and then gauge your ability to absorb that impact in your financial plan. And if you cannot absorb that impact, then it falls to the last decision-making process, which is, do you want to insure that risk or do you want to keep that risk? Once you decide on those, you can move into what you need to buy. So when we're talking about insurance, there are so many different policies out there. It is a very deep rabbit hole. Talking about life insurance, there's basically two different kinds. You have term life, which covers you for a term, a period, or whole life, which covers you for your whole life. You have to remember that if you're asking the insurance company to insure you for your whole life, it's going to cost a lot more money. So if you are buying it for a fixed term, it's going to be cheaper. So gauging the need, but then also how long do I need to insure that need is a very important component. I want people to always keep in mind that insurance agents are going to be motivated to help you find the products that fit for you, but there's also a compensation element. So I've run into it too many times where someone owns a whole life policy when they would have been much better served just owning a term policy. And so we have to keep in mind what your need is, what the duration is, and what the cost is on all of these different products. But term life policies, you can buy them from 10 years, 15 years, 20 years. They even have 30-year policies now. So if you're 30 years old and have a young family and you want to buy $1 million term policy for 30 years and you're in good health, it might wind up costing you $150 a month, where a whole life policy is going to be many multiples of that. So identifying which product type is going to fit your needs better is really important. Long-term care is the same. I mean, you can buy long-term care policies where you'll pay for your entire life on the policy, or you'll pay for a specific period of time. If you're paying for long-term care policies for a specific period of time, of course, the premiums are going to be higher, but you're not going to have to pay as long. So finding out what type of products are out there and available, they're all different and they all have bells and whistles. Long-term disability is just the same. How long will it cover you for? How will it cover you for your own occupation or any occupation? But once you decide which product is best suited to meet your need, the other critical thing to remember is there's lots of different arms and levers within a policy. So in a long-term care policy, things that cost money or will drive up your premiums are things like your cost of living adjustment, your compounding interest rate that your benefit's going to grow by. You can do simple interest, compounding interest, 3%, 5%. There's lots of different choices you can make. You can make choices on whether or not it provides for in-home care, or if it provides for any, or if it's a reimbursement policy or a cash indemnity policy, or if it's going to cover you for 2 years, 3 years, 5 years, 6 years. So insurance policies in and of themselves, once you pick the product, have all kinds of different levers that you can pull and change and tweak to try and make that policy more affordable or to fit within your budget. Another way to think about that as well is you can always go to your broker, your insurance broker, and tell them, this is what I can fit in my budget. This is what I can afford. What can I get for that? When it comes to life and disability and care insurance, they can modify those policies, hopefully to fit within your budget. There is a floor by which anything below that, of course, they can't do anything for you. But please know that it's not just an end all. You don't have to accept it for the face value that it's given to you. You should be able to work within the policy to modify that to your budget and hopefully fill that need that you have. Once you decide why you need insurance and you decide on what type of insurance you're going to get, the next step, of course, is to pull the trigger and to apply for the policy. I say it's a process, not a product, because underwriting can take time, especially when you're asking for life insurance or care insurance. A lot of policies in the disability area are what we call group disability policies. So these are policies offered by your employer and there's no underwriting, you just sign up. These policies are not going to be nearly as good as a disability policy you get on your own. It's going to be the same for life insurance. So just as a quick sidebar, you can get life insurance through your employer. There's a couple of problems with life insurance through your employer. One of those is it's rarely portable. They do make group policies that can be portable, but what this means is you can't take that policy with you when you leave employment. So think of getting a terminal diagnosis of some kind, or getting a lump that needs to be removed. Once that happens, you're uninsurable. If you leave your employer, you leave the life insurance behind, and that's a potential impact for you. So, and the other thing to keep in mind with your employer's group life and group disability is no one had to go through underwriting on that. So the insurance company is blind. Therefore, they charge more for those policies. So believe it or not, dollar for dollar, a group life policy is always going to be more expensive than an individual policy if you're healthy. So group policies are great for people who aren't healthy, but for healthy people that can go out and go through the underwriting process, it's much better. So sorry, sidebar. Yeah.
Can you pause just a little bit and talk about the definition of underwriting and what someone might experience going through that process?
Underwriting is the way the banks and the insurance companies mitigate their risks. I always like to say banks are not in the business of selling you something that you need. They're in the business of selling you something that they think you will buy and they will make money off of. And that's how business works, right? As much as they want to pretend that they're our friends, they want to sell us a product that they're gambling we will never need. But underwriting is the group that gets all the data, runs it through all their complex systems and their actuarial data and says, well, given that Eric's 51 years old, he's in pretty good health, but his family has a history of some health problems in these key areas. Given what his ability is to pay, then we'll make him this offer. And their job is to mitigate risk for the insurance company. And so it's important, as another sidebar, if you do go through the life insurance or care and you have to you go through an interview usually where they'll call you up and interview, don't offer any information that they don't ask for. This is always a mistake by people where they, this, and they just start talking about all these different health things and what's going on in their lives. And it's like, just answer the questions that they ask, because there is such a thing as too much information can be a bad thing. I don't know that I'm doing the definition of underwriting, the process any justice here, but just know that their job is to mitigate risk for the insurance company or for the bank. When you apply for a mortgage, it goes to underwriting, and those are the people that give you the yes or no decision. They're the people on the other side of the iron wall that you never meet, and the sales rep comes out and blames to the nth degree for saying no. We have no idea who these people are, but they're there and they make the decision. Was that helpful, Libby?
It sure was. I think we got a bonus. We got some definition plus some strategy. So
yeah.
Don't say more than you have to.
Don't say more than you have to. That's for sure.
Yes. And I want to thank the group for their great questions. Keep them coming in the chat.
Thank you. Another sidebar. be careful. I mean, this is really sad to say, and I hate to say it, but be careful what you tell your medical provider, or at least if you tell them and you don't want it in your permanent record, make sure they know that. And I hate to say that, but I've had clients that went in to get a policy that 30 years ago they said something to their medical provider and they found it and denied them because of it, or at least told them, well, this thing you said way back then needs to be rectified before we'll insure you. So, I mean, have open and candid conversations with your healthcare providers always. But I am very keen on saying, well, off the record, I want to have a quick conversation. And then my doctor always knows to put down the pencil and just listen. So anyway, just keep in mind, once you start this process, they're going to pull your medical records. They may even send a nurse to your home or your office to pull blood and urine samples and all these intrusive things to take a quick deep dive on you as an individual. They don't do this for like home insurance or car insurance. We're just talking about health related insurance policies on an individual basis. On the other side of that coin, for all the other policies, the same still applies. There are many bells and whistles. Your deductible, we're all familiar with that one. Ways you can play with your home insurance as well to get the premium into the space you want. But the less risk the insurance company takes, the less your premiums are, and vice versa. So always keep in mind that driving down premiums isn't necessarily the most important aspect of the insurance decision, because as your premiums get cheaper, your coverage probably gets worse. So you're taking on more risk by paying less. So keep that balance in mind that, driving down your premiums shouldn't be your own process. So once you decide to go, you put in your application, you hit the lever, and the whole process begins. I've seen insurance underwriting decisions take, months. So I always encourage people to be patient as they go through the process. The last thing we just wanted to talk about before we field any more questions is kind of how long do you keep these policies? This is a very common question that we get in the financial planning world. There does come a time where your focus needs to shift. I'm 51. Again, I always use myself as an example because I can never get in trouble for doing that. But I basically don't need life insurance anymore. I still have life insurance, so I'm hanging on to it because when I run my financial plan, if something was to happen to me in the next 10 years, my wife could not achieve her or our goals. But I'm not buying any new life insurance policies. I've now switched to long-term care. People come to us quite frequently with old policies that they bought. By stress testing those in the financial plan, we're able to tell them green light, keep them, or red light, get rid of it. So life insurance, long-term care, long-term disability definitely has a finite life, and understanding when you need to get rid of those is important. You kind of loop that back to, insurance as a tool that, you should know why you're buying something. So I'm a firm believer in that when you have an insurance policy, you should understand how it works, why you own it, and what its purpose is. But you should also understand how long you're going to hang on to that policy, so that when it comes time to get rid of it, you're ready to do so, or at least you've planned on that event rather than it happening to you. And with that, I think we've covered insurance basics. And I know it's a really high level. I apologize for that. We could get so deep in the weeds on insurance. It is really confusing. Having a really good insurance agent that is communicates well and is able to really walk you through all this and hold your hand is powerful. Working with a certified financial planning practitioner is also very important because they take your entire picture into account when helping you make decisions on which policies to own. But still, even if it's well thought out, why, what, where, and how, and everything else, most likely you're going to buy an insurance policy and hope you never need it, which is kind of a funny thing. I wish I could come up with a product like that. I'm going to sell you this and you're never going to use it, but you're going to pay me for it all along and we're all going to be happy. But the insurance company's got that, and they don't want you to use it just as much as we don't want to use it, but it sure is nice to have when you need it.
Well, thank you, Eric. You ready for a couple questions?
Sure, absolutely. I'll try my best.
Okay. I see one question here talking about long-term care coverage. And I know that you talked about, different ways of determining how much you need.
Yeah.
But do you have any ways to elaborate on that? The question is, how do you determine how much long-term coverage you need?
That's a really good question, and it really goes into what your specific circumstances are, what your ability to pay is. If you're working with a financial planner and they're doing financial planning for you in a holistic fashion, they should be able to help you answer that question. I can tell you how we do it, and then you can apply that to your own situation or having a talk with your advisor about it and see how to best work it. But for us, we use kind of national averages and state averages on long-term care. So there's a lot of published data on what the costs are per state and then what the national average is. But statistically speaking, long-term care is an event that the majority of us would need, if we do need it, would need for 2 to 3 years, and it would cost somewhere around $3,000 to $4,000 a month to do that. And that's in current dollar terms. And we find that to be true with our clients. We have a lot of clients in care right now. Well, I shouldn't say a lot, but maybe a half dozen clients in care, and they're all paying around that $5,000, $3,000 to $6,000 a month range. So they're right in there. And so we use that as a proxy for, accreting that out to needing care. So I'm 34 years away from needing care, knock on wood again, hopefully I never do, but, at 85, it kind of becomes a potential reality. So the care we bought, is the equivalent of, like a $4,000 check today, which will accrete to about an $8,000 check by the time I reach that age, and will cover us for up to 6 years. So we kind of double it up. Now, that being said, if you know your statistics, you got your parabola, this is right in the middle, right? We do have outliers. We do have clients that have been in care for a very long time, 10 years, 15 years. You also have clients who need care for like 3 months and then it's over. So all you can do is really assess how much you need based upon your current situation, what you have to be able to pay for care, and then how much more you will need to fill in that bucket and when you might need that. So I hope that's helpful, but, without taking a really in-depth look at someone's, total picture, that's a hard question to answer.
Sure.
Yeah.
And then another question along those lines, what do you think about insurance combined with long-term care?
Oh, I thought you were going to stop with, what do you think about insurance?
Yeah, let's go back to the beginning.
I was going to say, well, I don't know. I think I made that pretty clear now. Yeah, insurance. Actually, I think it's a great product. So some of the new products out there are these universal life policies with a long-term care rider. And that's what my wife and I bought last year. There's a little death benefit. You don't buy it for the death benefit. You buy it for the long-term care, but it's a different animal. So traditional long-term care policies, you usually pay for life. So, Mutual of Omaha is still in that game. They've got a pretty good long-term care policy, but you pay the premiums as long as you have the policy. I don't know all the subtle nuances of their policies. So if there's a Mutual of Omaha person on the call, then forgive me if I'm cutting that short. But so sorry, to come back to your question, the life and long-term care is a new product type that the insurance companies have been coming out with. I think Lincoln started with it, like 10, 15 years ago, and that segment has grown. I think that they can be really powerful. The premiums can be fixed for a particular period of time. And one of the things with these policies as well, such as the one that my wife and I got through Minnesota Life, is basically if you die, the death benefit is your premiums coming back to your estate. Some of them have a return of premium rider, which means if I ever want to walk away, I can have my premiums back. Or if I need care, they're there to pay for it. So I think you get some good flexibility. I certainly wouldn't take them off the shopping list if it's something that you're looking at.
Thank you, Eric. And I might roll us back a moment. I think insurance, we need like a glossary of all these different terms. So you talked to us about underwriting. How about the term rider? What's that reference?
Sorry. Yeah. Sometimes I joke and I say we keep it complicated for job security purposes. But if this was easy for
It's kind
everyone
of
to
another
figure out,
language a little
yeah,
bit.
it's, it's kind of like doctors. Have you ever gotten a doctor in the room and tried to talk shop with them? Holy cow, you don't understand a word they say. It's called job security, people. Yeah. So a rider is something that you add on to a policy. For instance, we were going for a long-term disability policy for our firm. I'm a skydiver. This is normally excluded in a long-term disability policy, so I would have to add a rider for that additional coverage. And of course, that's going to cost me money. And so a rider is when you add things on. My long-term care policy, it has a return of premium rider. I pay extra for that, but what it means is if 20 years from now I win the lottery and I got a lot of money and I don't need care insurance, I can cancel the policy and get all my premiums back. So riders are just these little add-ons to a core policy. So usually when you buy insurance, you get like a core policy that is applicable to everybody almost, but then you can add riders onto the policy to customize it to your particular needs.
Okay, so we're all caught up on a new term. Thank you. So could you talk a little bit more about the need for disability insurance and how that kind of is in the mix with long-term care and life insurance?
Yeah, thanks for that. I mean, it's an important consideration. I don't remember where I got this stat, but again, between 25 and 65, your probability of disability is much higher than death. Some people think of disability as, you're jumping out of an airplane or you're whitewater rafting or you're out surfing and you crash and hurt yourself. Disability can take a lot of different forms. There is short-term disability and long-term disability. Short-term disability is just what it sounds like, covers you for 90 days. Long-term disability starts covering you day 91 through whatever period of time that it lasts. I really like to see people with disability policies in place as much as either life or long-term care. It provides for income. So most long-term disability policies provide for 60% of your pre-disability income. And that's because the benefit is designed to be tax-free. In other words, you pay the premiums when you get the benefit. It's not taxed to you. And I want to talk about one caveat on that, but real quickly. So it's 60% of your pay tax-free. So if you kind of do the math and you're avoiding Social Security tax and federal tax and state tax, if you're in a state that taxes you, 60% should keep you whole on a net income basis. But if your employer is paying the premiums, your benefit is taxable and it's still 60%. If your employer is not paying the premiums and you are, the benefit is tax-free. So I run into this a lot, and I'm not sure why a lot of disability salespeople sell the ones where the employer pays it, because then the benefit just became taxable, and 60% of your pre-disability income that's also taxable means you're getting like 50 or 40% of your pre-disability income. But I really like disability insurance, and probably the need for disability insurance starts running out around 55 or so, because most disability policies are only going to pay you to 65 when you become Medicare eligible and Social Security eligible. So for me, depending upon your savings and the type of job you have, that disability policy is probably really good to have between like 20 and 55. Somewhere around 50, you should start thinking about long-term care. And life insurance is really individual specific about what your needs are and what your resources are and what your ability to absorb a potential death is.
Thank you, Eric.
Yeah.
I do have a question about the need with life insurance, how much
Mm-hmm.
coverage you need.
Mm-hmm.
Would you ever recommend different levels of coverage for spouses, not necessarily defaulting that they both have the same amount? Or, you talked about your wife being, at home.
Mm-hmm.
Would you insure her with life insurance? So just how does it work with two people?
That's a really good question. And yeah, absolutely. Everyone's individual, and the need for insurance is different. So again, to keep myself out of trouble, I'll talk about me. So when I first got life insurance on my wife and I took out $1 million policy on myself for a period of, I think it was 15 years or 20 years, so that my wife could, basically, I did a needs analysis, and I've always done it on need, but it was, I want her to be able to pay off all the debt. I want her to be able to buy the dream house that we never bought. I want her to be able to pay for a wedding for my daughter. I want her to be able to get $50,000 a year in income until the kids have all moved out. And so I just added up all those numbers and it came out to somewhere around $1 million. Now with my wife, she's a stay-at-home mother. She wasn't earning at that time. Then we had 3 kids in the house. The real risk for me as someone who works, the 8 to 5 traditional is if something happens to her, I'm really in a bad spot. So her needs analysis was, I need to hire a full-time daycare provider until the kids are a certain age. I want to be able to do that. I figured it was 10 years that I would have to pay someone full-time to help me with the kids. I figured it was $50,000 a year, roughly. This was back in 2002 or something. And so I got $500,000 worth of coverage on her. So I think really when you look at it, the needs-based approach is a great way to look at life insurance and how much you need when people have different income sources. Now, let's say my wife and I were both earning $50,000 a year, and we wanted to be able to provide that income to the survivor for the rest of their lives, then that's pretty simple. 50,000 divided by, let's say, 3%. How much does that equate to? And it's probably somewhere around 1.6 or 1.7 million or so. So you can do that simple math on the life value approach, or you can do the needs-based approach and decide. But yeah, you don't need to cover everyone equally unless the death of both people has equal impact on the family from a financial perspective.
Thanks, Eric. We have another question.
Sure.
Any guidance on how you set up or select your beneficiaries?
Oh boy, geez, God, these are all good questions. I can tell we actually have more interest in insurance than I thought we would have. Setting up beneficiaries. Yeah, I mean, that's really tough, right? I mean, obviously, if you're with a significant other, whether you're married or not, doesn't really matter. But, you buy the insurance a lot of times to protect that person. And so that person becomes your beneficiary. There are lots of little games you can play. Some people buy insurance policies because they want to benefit charity. So maybe my favorite charity becomes the beneficiary of my life insurance policy, or maybe I want my grandkids to benefit, or maybe I want 2 of my kids to benefit and not one. So, I won't say who that is if they're watching, but, naming your beneficiary can have an impact on how that passes. I think, by default, it's just always your significant other or your kids, whoever you want to benefit the most from the policy that you have. And I think this is really mostly applicable to life insurance because there's really no other place. I mean, long-term care, you really don't name a beneficiary for that. You are the beneficiary for that. And if you're dead, it's gone. Or disability, you are the beneficiary. So I think it really just is applicable to life insurance. By default, it's going to be, your significant other first, spouse, a domestic partner, whoever that is. Second is going to be your kids, I would imagine. And then after that, you kind of get into the grandkids or your siblings or whomever else you want to benefit from the policy. There are reasons that you can play a shell game and name people that you wouldn't traditionally name, but usually that's because you're wealthy and have a lot of money and want to be able to push around money to people without taxation. So most of us don't need to worry about that. So if you have a really complex situation, a lot of times it's good to talk to an estate attorney about who I name as beneficiary and why and what the benefits are from me on a tax basis.
All right. Well, we may have 1 or 2 more questions and then we could wrap it up.
Okay.
I see a question here about if you are self-employed and you deal with chronic diseases, it doesn't fit into what you're talking about with the employer provided policies. Do you have any advice around that scenario?
Yeah, I mean, if you're self-employed and you have no employees, You can't really get a group policy. I mean, if you have employees, there's some companies that will issue long-term care or long-term disability or life policies to small groups. Usually that's like at least 3 people. So like you and 2 employees. But if that's not you, if you're just self-employed, period, let's say you're paid 1099 income, there aren't a lot of options except individual policies. And if you're dealing with chronic illness, it really depends upon what that chronic illness is. And this is a good point to bring up. All insurance companies are not the same. So here in the state of Oregon, marijuana is a legal drug. You could buy it down at the local store and use it. Some insurance companies will automatically rate you as a smoker. Other companies don't care about that. Some companies don't consider cigar smoking tobacco use. Some do. So it really depends upon the company. So at least when you work with an agent, you can say, these are my illnesses. This is what I'm dealing with. And then they're able to determine which companies care and don't care the most about that. But yeah, in the end, I mean, if you're dealing with chronic illnesses that prohibit you from getting life insurance policies or long-term care, there's really no easy way around that. And that's a tough one. So saving for insuring yourself is probably the best path.
Well, I think that's about all the time we have for questions.
Okay.
I do want to encourage our viewers, if they didn't have a chance to get their question answered, go ahead and leave your phone number in the chat if you haven't already, and we'll make sure someone reaches out to you after today's event to address your question. Once again, we want to thank our speakers for being here today. Thank you so much, Eric, and thank you, Libby, for being here. Thanks to the organization that made this webinar possible. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. So once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
Thank you, Marche. Bye-bye.
Thank
Bye.
you.